Does this change anything for the path of the Federal Reserve through the next 12 months? Is it too early to tell?
Well, 12 months is a long time, but I would say for the next month, it probably does not. I mean, Erik is exactly right. Mike said the same thing. I mean, look, this is just where we are, right? This is why the fire and ice narrative, is so important to kind of understand. We're getting squeezed on both sides as it relates to risky assets, particularly equities, okay? Now, that doesn't mean that everything's uninvestable. It just means that you have to think about, what works and what doesn't work in this kind of environment. I would say it's going to be difficult for the Fed to pivot anytime soon. All right, we know the data is not going to get meaningfully better. It may get meaningfully worse if oil continues to spike. I would say the thing that's going to get the Fed to pivot probably is not going to be inflation coming down too fast. It's going to be that growth starts to really roll over, right? Because we're now getting to levels where there may be demand destruction. That's been part of our thesis. And that may play out now faster. And so if that happens, we could see the Fed pivot at some point in the next, say, 3 to 6 months, but it won't be for good reasons. It'll be for reasons that are probably equity disfavorable. That's the challenge. You're getting squeezed on both tighter financial conditions and slowing growth. And that's our thesis for 2022. It's just playing out faster than we anticipated because of this unfortunate event.
Mike, you hear a lot about the S word, stagflation. We've asked several guests through this morning whether the game has changed for them, whether they're ready to talk about stagflation and what it means. When you go through various scenarios and introduce the stagflation word to the conversation, Mike, where do you want to be in that environment? Where in this market?
Well, I mean, historically speaking, stagflation is not particularly great for anything. I mean, commodities is the easy one to kind of say, okay, fine. Anything that has variable income that can grow in a world where there's inflation, like that's not really our base case. In other words, I would suggest strongly that if inflation gets out of control or it doesn't come down, that it's going to have a recessionary effect. Okay. And that therefore policy can reverse course. I don't think it's the 70s. I think it's the 40s. As you know, we've written about this extensively. I think the risk we have now is a boom bust, classic boom bust scenario. Last year was a boom. Everything's short. We have supply. Supply now picks up. You actually get a deflationary whiff in consumer goods. That's kind of our base case. That sounds good on the surface. The problem is it's bad for growth. So we got to digest that. And that's probably 2 quarters of digestion. We'll come out the other side of this on the back end. Notwithstanding, we don't know what's going to happen with this event that we didn't predict, obviously. But let's assume cooler heads prevail at some point later this year. There could be an reacceleration expansion later this year, but we're just not there yet. Right. We're not priced for that. And we're not in a place where growth is going to accelerate anytime soon.
Mike, what will the deep pools of money do? What will private equity do? What will the cash cows of corporate America do here? They've got a huge down market opportunity. Do you, James Gorman and all, just suggest they will go, go, go?
Well, there is a structural change. I would say, 10 years ago, Tom, everybody was afraid of inflation after the GFC. We didn't get it because obviously the money never left the banking system, right? It was stuck. And it was secular stagnation. It's different this time. We pumped the money right into the economy.
Yeah.
That was different. Helicopter money. We have inflation. We got more than we bargained for. And so there is an argument, to be made for the great rotation is now upon us. And that's what we're seeing with our asset owner clients, be it individuals or pension funds, et cetera. They've made the active decision to reduce, bond exposure, increase equity exposure permanently, right? That will buffer some of the downside, in my view.
Yes. Well, it's going to buffer the downside, but then what that comes down to is what everybody owns. There's retail own, there's hedge fund own in that. Let's ask the elephant in the room question, which is what does big tech do here?
Well, as far as the stocks go, we're seeing what's going on. We're working off a unsustainable valuation bubble in a lot of parts of the growth markets. All right, that doesn't mean the fundamentals are in terrible shape. It just means these companies need to grow into valuations that were unsustainable for the world that we're in now. Regime shift towards higher inflation, higher cost of capital, and so I'm not of the camp that it's value versus growth, and you can only own one, not the other. I think it's just going to be more idiosyncratic. Let's pick, securities that have, the reasonable pricing for the growth outlook that's achievable. And so that's going to be a mix of value and growth. It's not one or the other. But I would say the growth stocks still have some downside with respect to valuation.
Erik, we've been hearing a lot about the United States and sort of the incredible momentum that the Fed is facing off with and has to justify somehow a dovish tilt with. From your perspective, how different is the picture right now in Europe, especially given the exposure to Russia directly through gas and oil, but also just economically?
Yeah, I mean, this does change things on the margin, certainly from a economic growth expectation standpoint. It also changes things from a fiscal or a monetary policy standpoint. It is quite possible that this represents kind of peak hawkishness in terms of expectations for central bank rate increases. You've already seen the 50 basis point increase in March taken out of expectations. The market was pricing 6 to 7 increases by the Fed, 5 increases by the ECB. We've been on the under on that. And don't think that now that the central banks will have to raise rates as much, they can move in a more measured and gradual pace as they try to assess this more challenging growth and inflation mix. As we work with our institutional clients, they've been assessing relative opportunities in Europe versus and Japan versus the U.S. And we've been gradually tilting into those areas. Europe, up until basically 12 hours ago, has been outperforming the U.S. from an equity standpoint this year. And so, this is a much bigger picture than just one action. To size this, the GDP of the Ukraine is $164 billion. I mean, that's a fraction of global equity market cap. That's a fraction of European market cap or U.S. market cap. Russian trade is $500 to $600 billion. Half of that goes within the CIS. And that's, again, 1 to 2% of global trade. So what we do think is that we likely have seen not just peak hawkishness on central banks, but this reinforces the notion that we've seen kind of peak globalization. All of these things lead to a challenge both on the growth side, although we don't think this meaningfully increases recession risk, given kind of the relative size of what's at play here from a kind of global GDP standpoint. But it also does fuel potential for higher inflation, given that challenge around likely less globalization, less trade from here.